shares of several regional banks did bounce back today. In particular, First Republic up nearly 30%, but still down more than 60% over these last 5 very tumultuous days. For more on the sector and the impact of the SVB crash, we're joined by Morningstar equity analyst Eric Compton. Eric, good to see you. How does Moodys slapping a downgrade watch on 6 U.S. banks impact your expectations?
Yeah, so I mean, we broadly agree with the sentiment expressed by Moody's, where in our own forecasts, we are going to be acknowledging some of these, for example, increased funding pressures. I think they're absolutely right about that. There's going to be increased competition for deposits. Banks are going to want to shore up the funding side of the balance sheet, and so yeah, that's going to hit. It's going to hit net interest income. It's going to hit bank profitability. You could see things like increased regulation in the future, which would also likely be a drag on profitability. So broadly agree with the sentiment there that bank profitability is going to be pressured over the next several quarters for sure.
Just want to follow up on you actually think there's a path to increased regulation, as in getting legislation through a Republican-led House?
I mean, legislation or increased regulation could happen through several avenues, and it could take more than the next 6 months or a year. So I just think over the longer term, regulators do not look good right now, and they're going to want to change things to ensure something like this doesn't happen. And some of those changes you could see come from the Fed, come from the FDIC, increased regulatory capital requirements, changing how regulatory capital is defined, things like that. So nothing for sure there, but when a blow-up like this tends to happen, you tend to see more stringent regulation in the future.
Eric, put this in perspective for us. When you look at the collapse of SVB, comparing SVB to some of the banks that are in your coverage list, and some of those names have been hit hard over the last couple of days. Comerica, First Republic, Zions, they all initially took those hits. How did they stack up when you compare them to SVB?
Yeah, it's a great question, and one that we're getting a lot is how unique is SVB? And the answer to that is SVB was very unique. When you look at, for example, the unrealized losses on their securities book compared to total capital, equity was a 0 at that point. And then it was just a question of, are they going to have to realize those losses? No other bank under my coverage comes anywhere close to that amount of duration risk or unrealized loss risk. So SVB was unique in that regard. Some of the metrics you all highlighted before about just deposit flight risk, uninsured risk, SVB was also fairly unique in those regards, and all the banks under my coverage score better on those screens. And so on the one hand, SVB was a unique situation, and maybe all the regionals under my coverage survive from here. I don't think there's a reason why any of them have to be the next one taken over. However, the big unknown is, does this create enough fear where you create enough deposit flight from one of these institutions where it potentially puts it into stress? So all the banks under my coverage, very different from SVB. However, no bank is completely immune to a bank run if it is large enough, is the unfortunate reality.
Of course, the biggest banks, the biggest difference in that regard, you still have some buy on some of those. Who and why?
Yeah, so we think that while acknowledging the high level of uncertainty right now, the market is pricing a lot of these banks as if they are going to be, they're trying to discount who the survivors are and who aren't. And so these banks, especially a lot of these smaller regionals, if they survive, these distressed prices will likely go up. And so under my coverage, some of the names that have sold off quite a bit, looking at like a Comerica, for example, if they can keep that deposit base intact, today's prices just aren't going to make a whole lot of sense. Zions is another one that kind of comes up where they did not take much risk on the security side of the balance sheet. The losses compared to capital are not that high. The big question is, and no one knows for sure how deposits are going to shake out, but if they can keep that deposit base intact, today's prices are going to look pretty good, I think, 2-3 years from now. So those are some of the names I would highlight. Truist is another one where they have the benefit of being one of the larger regionals. And so I think maybe more incrementally likely to maybe see some of those deposit inflows. And they've also sold off pretty hard. A little bit more unrealized losses for them. But in the end, I think they make it. And if they do, today's prices, I think, will be a bit higher 2-3 years from now once this initial shock kind of plays out.
And Eric, though, talking about the short term here, the current environment, how much tougher does this make it to gauge or predict deposit flows, to predict funding costs? Does that make it exponentially more challenging for you as an analyst?
100%. The difficulty of the job being a bank analyst has gone up a lot over the last couple of days. And at the end of the day, I just have to admit, and I think anyone who's being honest has to admit, no one knows for sure what deposit bases are going to look like in next quarter's results. And that's the big uncertainty we're dealing with. And you can try to put guardrails around it, predict who's better or worse positioned. But at the end of the day, it is going to be very hard to predict what deposit bases look like in the near term.
All right, Eric Compton, Morningstar, thanks so much. Always great to have you here.